This is webinar number 8. So today is a little bit of just market updates, what's going on, and then some opportunities we've been discussing. So here are our disclosures, what we're talking about, primarily that this is my opinion and my opinion only, not that of Raymond James. And then our outline for today. So we're going to go through now. One of the things I recognize is while I've done a lot of these webinars, not everyone is present for all the webinars. And so what I'm going to try to do is it's going to be a tad bit of recap. I'll move through it a little bit faster, and then just kind of an update on where things are. So the opening up America, again, we'll talk about what the plan is. We'll talk a little bit about unemployment at 22 million and counting. I think now, as of fresh data today, we're now at 26 million and counting, and why that might not matter. The stock market is not the economy. That's going to be the highlight of today, is really talking about the stock market is not the economy, and we'll break that down and then just give you an update on what's going on with investments, what's happening with the overall markets. And then we'll have time for questions at the end. Okay, opening up the economy. We've all seen, and we're getting inundated with information about the opening back up. The phase 1, the phase 2, and the phase 3. So I think the unfortunate part for all of us is phase 3, meaning wide open, is a long way out. And it already is, phase 1 is already starting in many states. California is a bit of an unknown right now. I don't know when that's going to happen. My guess is the 15th might be a pretty good deadline, maybe even the end of the month, around Memorial Day. But it's clear that we're starting to see, the hospitals are, I think, in a good position to help. I think we as a nation are in a much better position. We're getting more testing. So the right things are happening. But I think the scary piece is, what's the lasting impact of this? What are the ongoing ramifications of this pandemic? And also, what's this going to do for kind of the health of the economy going forward? Because we know there's going to be future pandemics. We've had them in the past, not to this magnitude clearly, but we know that this is going to be something that's going to kind of be built into our economy ongoing, and how do we react to it? And so this was just mainly a slide so that you can kind of see what some of the professionals are saying about how this is going to manifest itself. I know a lot of people are getting kind of ready to get back to work, ready to start socializing with family again. So this is kind of the high level stuff of, going from barely open, which is likely coming soon, hopefully in the next 2 weeks. And then again, just kind of structuring through. The crazy thing for us to think about, at least in my household, is, are the kids going back to school? How do you social distance in classrooms that are heavily impacted, right? We already knew our classrooms are pretty crowded. So it's gonna be really interesting to see what the game plan is for that. So, but the good news is we're talking about the opening back up, where 2, 3, 4 weeks ago, it was just keep pushing it out. So we're making some progress there, which is great. This is a reminder. Again, I went through this last week, but let's talk about being unemployed. It might not be so bad in the short term. So a lot of data up here. This is just a healthy reminder from last time. So for those individuals that are on unemployment and are minimum wage employees, which is in that $14 an hour range, working half-time, full-time, you also have $16 an hour. So on the left-hand side, I have a bunch of different scenarios. And then in the middle, actually, and I'm gonna bring a different pointer option here so you can see. So now I have my fancy laser pointer. So here in this weekly UI, that's weekly unemployment insurance. I went onto the state of California website and gathered this data. So it's pretty accurate. I don't say it's 100% accurate, but it's pretty close. And then, so that's the California unemployment insurance. And then the extra weekly payment is through the federal government. And so this is going to go through, as it stands now, through the end of July, and that's an extra $600 per week. So you can see the federal support dwarfs the California payments. Especially someone minimum wage full-time would be getting only $285 per week. That person is now getting extra $600 a week, which means that their actually weekly payment is more on unemployment. And so if we move all the way over here to the right, where it says income for 4 months. So if you had been on unemployment for this whole period of time, for the whole 4 months, and you are in these categories, you can see that minimum wage are getting somewhere between $5,000 and $8,000 more during this period on unemployment than they would have been working. And then you can see this does apply at a lesser scale, up to about 25 an hour. At 25 an hour and up, you can see the benefits of being at home, not working, start to go away, where at 35 an hour, you're actually taking home less. And so you can get a decent snapshot of this. And so while the numbers are certainly frightening, 26 million, In most industries that we're talking about, a fair amount of those jobs are coming back. There are a couple industries, right? The mall sector, retail, those are going to be industries that are going to take some time. Airlines, cruise lines. So that's why I kind of make the case that the unemployment number is not as scary as the media is making it out to be, because the government has put this protection in place to really help to cover the bills and cover the expenses of people. And, and with this data, this would show that they're actually going to be in a better place because they're getting more money, number one. Number two, they can't spend their money anywhere. That's one of the things. We're on shutdown. We all know our credit card bills have come down quite a bit because we're not spending money on discretionary stuff, like filling up the gas tank or going on a vacation or going out to have a nice dinner, planning a trip. So all those things have cut back. So unemployment is clearly a bad thing, but under this situation, those people who are unemployed in many cases are actually not in a terrible financial position. The question comes as we start to open back up. Let's just say May 15th, we're ready to go back to work. What about those people who get called back up by their employer and they're just like, no, I'm just going to stay in unemployment because I'm going to make more. So that's one of the dangers we might have is the state going to say you're not eligible, but the federal government might make them eligible. There's so many people in the system that it's been hard for people to verify, are they really on unemployment or are they on unemployment by choice? And so that's the really sticky situation that we're going to come through is, well, what does this look like? So I don't want to spend much more time on that, but that's one of my concerns is as we open back up, there might be a group of workers who are like, nah, I'm going to take the next 2-3 months off. I'll figure it out after that and go back to work. And that might actually hamper businesses because if they can't get people to come back to work, how are they going to run their businesses? I know that's a happy problem to have that conversation about, but that's one of the unintended consequences of a really robust unemployment system right now that we're seeing and these unemployment payments. Okay, so we're going to go through, I think it's like 3 or 4 slides here that really talk about the stock market is not the economy. So I'm going to read through this a little bit because I do get a little bit technical, and I'm going to try to use my laser pointer here to help us kind of through the system here. So what we're looking at here is the U.S. economy has over 28 million companies, and small businesses make up 99% of all these businesses and basically 48% of the employment. The S&P receives more of its revenues from overseas, so it should benefit from like the turnaround in the world. And so if you think about the small business employment, the total employment, this shows all the different sectors of where they're impacting. So agricultural, construction, real estate, arts and entertainments, food services. Sorry, I'm trying to read sideways here. So it shows you all of these industries and basically the small business share as a percentage. And the reason why I'm saying the stock market is not the economy is most of these companies, the small businesses especially, they're not publicly traded. They're not invested in by us. And so that's one thing to really know. And then you can see over here, this is item number 1. And number 2, the S&P receives more revenue from overseas. And so you can see a lot of our big companies, because we have the best brands in the world, they get a lot of their sales from overseas. And so even though I know this is a global phenomenon, some of the issues we're having here in the US are being felt by everyone. But just remember, the US economy, because of the small business footprint, is not necessarily exactly what the S&P is doing. And so I'm going to go through and give you some slides. And remember, the S&P, let me be more specific, the S&P 500 is the index of the 500 largest US companies. So just to give you an idea of what that is. So if we start looking at the biggest sectors that make up the S&P is technology, healthcare, and communication services. So it actually represents 52%. So over here, you can see this is the weightings of these sectors. So technology, healthcare, and communication represent 52% of the S&P. So 52% of the companies in the S&P are in those sectors. But if you actually look on the right-hand side, it shows, well, as a percentage of our overall economy, what do these companies make up? And you can see that it's only 17%. So 52% in the S&P, but only 17% in the overall economy, which is, again, one of the reasons why we've seen the S&P kind of bounce back is because these sectors are thriving right now. In technology, healthcare, and communication, they are thriving. And so that's one of the reasons why we've seen this bounce back, because it's not an exact reflection of the current economy. All right, so as we then start looking here, you start looking at like consumer discretionary. So when you think about consumer discretionary, so this is kind of the next sector into this, Consumer discretionary, we would think, is discretion, right? Money that you don't necessarily have to spend, things that you want to spend. Well, you know what's changed so much about our discretionary spending is a big chunk of our discretionary spending is now at using like internet or direct retail and home improvement. And those are actually, doing quite well right now. You're hearing lots of stories on home improvement. People are around their house realizing they don't like things about their house. They're trying to fix them. They have time. And then people are still purchasing. There's still access to Amazon. They're still purchasing. And so if you look at a lot of these at-risk industries, I would make the case that these top two are not. But even then, look at the relative percentage of the impact of all of these. So as an example, casinos and gaming, 0.1%. They're a very small amount. Now, I do want to remind you that as an investor, we're not just invested in the S&P 500. We have a broad, diversified portfolio. So our portfolios have a little bit more exposure to some of these other areas just because we're more broadly based. But it's just a healthy reminder of why I think we are seeing a rebound pretty quickly right now. 2 reasons. One is because of the fact that we're getting the technology sector, the healthcare sector, and communications are doing quite well. And the other side is just because there's so much money coming into the system to really backstop the financial concerns that we have. The Federal Reserve is just pouring money in. The federal government is pouring money in, and this is really helping things get back to normalcy from an investment perspective, but the economic perspective is going to take a little bit of time. So financing conditions. And so this gets a little bit technical, but if we look over here, so we think about like, okay, so when you have what would be called a high quality borrower, which would be investment grade, and then you have high yield borrower, which would be below investment grade, which means more at risk. So investment grade, high quality, high yield, otherwise known as junk or lower quality. You can see of the S&P, we have a lot more high quality firms in the S&P 500. So one of the things that we are seeing is that Raymond James, especially, they like the larger company stocks because of this phenomenon. Now, we think there's some opportunities everywhere, so we're making sure we maintain diversification. But that's one of the reasons why you are seeing pretty much across Wall Street, and it's really kind of becoming maybe a crowded trade where everyone's kind of agreeing large company, meaning S&P companies, are going to be doing the best. And a lot of it is because of this data, the fact that they are higher quality, they have more cash. And then if you look over here on the right-hand side, you can see we start getting into that the corporate bond yields remain pretty low. And so when you say they remain low, that just means relative to treasuries, what's been happening. And you can see, they've come back down. So we saw a big spike up when we had all these concerns initially, and that's come back down to some normalcy. So this was the height of the panic, was when interest rates spiked up. And when that happens, what does that mean? That means there's no buyers, only sellers, because interest rates will spike up, prices go down. So I know I got into the weeds a little bit on this, but I wanted to just kind of share with you a little bit of just a reminder of that the stock market is not necessarily the economy. And there's also a lot of good companies, strong industries that are inside the US stock market that are actually thriving in this environment. So this is a repeat from last week, but I thought it was worth mentioning again. Sometimes I realize in doing the webinars, it's like drinking through a fire hose. I try to process this information and pass it on. And I've been looking at the slides, reading the slides, preparing for today. And I take for granted, like sometimes how complex some of this stuff is. So I do want to share this slide with you because I thought it was pretty interesting. So this is put together by Larry Adams of Raymond James. And he's kind of talking about what's the recovery going to look like. And people talk about, is there going to be a V-shaped recovery, which obviously would be a sharp bounce back? Would it be a U-shaped recovery, which means it's going to take a little time from the bottom and make our way back up? Some people have talked about the Nike swoosh recovery, which if you think about a swoosh, it's like a check mark, it goes like that. Or Larry Adams talked about what he called the K recovery. And so what this basically means is that certain industries are going to benefit in different ways. And so if you look at, we're going to kind of go down the list. So I'm going to use my pointer here. So first one, over leveraged cash flow driven small businesses. So if you have a lot of leverage, you're going to be in a much tougher position, meaning you have a lot of debt. So what's happening is as you come in here, we had this initial drop, right? And unfortunately, what happened is a lot of these companies are they're going to continue to go down. They're not going to make it out of this. We are already seeing bankruptcy filings from, I think it was Neiman Marcus, and maybe JCPenney's is on that list, a few oil companies. We're going to continue to see more of those. There's plenty of businesses that probably should have been knocked out of business years ago and just kind of stayed, but aren't relevant in today's economy. And so those types of companies probably are not going to make it and get through this. And you know what? That's not necessarily a bad thing. The purpose of an economy is to reinvent itself. Sometimes when you have disruption like this, it's a good thing. It kind of cleans out the excesses. It gets rid of, maybe businesses that have basically overstayed their welcome, and they actually weren't businesses that should have thrived in this new economy. So then the next one is airlines, entertainment, and car sales. So if you think about this, we all had this initial dip. Now we're here. What happens? Well, maybe we get a little bit of a bounce, but you know what? The airlines are going to take time to come back in. We may not have the middle seat anymore. People might decide, you know what? I don't want to go to the movie theaters. Entertainment might struggle. Car sales, people might realize, you know what? I didn't drive as much, or maybe the replacement, they realize they can just not replace their car. So these are the kind of industries that might see an initial pop, but then might kind of go back down and then have a much longer recovery coming out of this. Home improvement, surgeries, and technology. We definitely think that's an area that we saw the initial sell-off down, and then the recovery is already occurring. We're seeing home improvement sales great, technology is strong. And so then we get into like this last category, which basically is the category that never went down. It went straight up. Medical supplies, e-commerce, and streaming, right? As we were stuck at home, we know streaming was a big part, getting our data from Netflix, Amazon, whatever it is. We were watching a lot more TV, being on the internet, on social media, e-commerce as well. We've seen Amazon's been hiring. They're still seeing booming sales. And then medical supplies, anything in the medical testing, supplies, e-health, things like that. We've continued to see strength there. And so these are industries that just kind of went straight up through there. So the recovery, the one thing that I think I have the most clarity on is the recovery is going to look very different for different businesses and different industries, and leadership's going to be critical. And those industries, those companies that are in industries that are growing are clearly going to be the winners. And I think we know what those are going to be. The question becomes, from an investment perspective, we all know that these are going to be the winners. And what does that usually mean? That means that those companies tend to get overvalued, right? Because if everyone thinks that, oh, Amazon's going to be great, well, what happens? The price of Amazon didn't really come down. And so, these types of industries and companies are actually thriving and doing fine, but it also means that their share prices are much higher. So that means they're more expensive. And one of the things as investors is we want to look for where the value is. And so I did want to give you just an update on where things are. So as we stand as of last Friday, and we've seen 2 good days in the markets, the S&P 500 is down 11% for the year. And then you can see some of the other indexes. And so the Russell 2000, which is smaller companies, is down 25. International down in the 20s. The NASDAQ, which is tech heavy, you can see is only down 3. So you can see a big bifurcation of performance. You can also see kind of straight down here how all these different industries have done. Healthcare is down 1% year to date. Technology down 2.9. Consumer staples down 6, right? So you start looking at, and you can see consumer discretionary, consumer services, they've all done fine. And what's really struggled? Energy, financials, right? And so those numbers on there are the percentage decline. So for example, the healthcare is down 1.1, energy is down 41.3. But guess what the best performer is since the bottom? Energy. So if you actually look at what's done the best from the day that hit the bottom to energy, well, why? Because it went down so far, it bounced back a lot faster. And then when we start looking at what we would call asset classes, and so I know sometimes in our meetings, I bore you with some of this conversation around what's large cap or mid cap or small cap. Those are just the size of companies. And then you have value, blend, and growth. And so if you look at, this represents the performance year to date of large growth companies is actually only down 4, where small value is down 33. So it's really interesting. And today is kind of an interesting day to do this. And so if we just took a snapshot of the last 2 days, and let's just say on Friday, we got all this data and you said, you know what, large growth looks like the best place we need to be. It has held up. It hasn't gone down. Well, as of these 2 days, if we just reflect on this week, large growth is basically flat for the last 2 days, and small value is up about 7 or 8% just in the last 2 days. So what we think is going to happen in this recovery is, while we do favor some of these sectors like healthcare, technology long-term, because they just have really good fundamentals, in the short term, because they haven't sold off as much, the recovery might be a little bit more mixed. And things that we are convinced that this has to happen and this is going to be the best sectors, because we've seen such dislocation with performance, the recovery is not going to be smooth. And that's why being diversified is still going to be really critical. And that's something that we've been doing in the portfolios. for our clients. And so just wanted to give you a snapshot. There's a bunch more numbers there we're not going to share. So I'm going to kind of wrap on a kind of a fun slide that Raymond James helped us put together. Staying social while social distancing. So we kind of all know what this is. When you start looking at how do we stay connected, phone calls, video chats. I mean, we've had more video chats, you know, at my house, at the office, with just friends, with clients. This is how we're communicating now. Social networks, and, you know, even having like, you know, these virtual viewing parties. I haven't done anything like that, but there's all these ways we can connect. And now that people have connected in this manner, this is going to become normal. I think for a lot of people who are like, no, I like old school, I want to do it in a different way. I think it's going to become more normal. I don't think it's going to replace, it's just going to be an add-on. It's going to be a way for us to connect even better. Moving. Well, you know, because the gyms are closed and, you know, especially, you know, in some cities, you're living a lot more tightly. You have to work out at home. There's a lot of fitness apps, things like that, which is obviously connected people. So even though we are social distancing, which frankly is a strange word, shouldn't it be, you know, physical distancing and we want to socially connect? It seems strange to me that it's called social distancing, because right now we're at a time where we actually want to socially connect with people. We have all these apps, this technology to stay fully connected, but we're calling it social distancing. It should be renamed. If we're physically distancing, we got to stay away, but socially we need to stay connected because we're human beings and we thrive off of that. Host virtual happy hours. I know there's been a lot of that going on. Digital dinner parties, writing, messaging apps, maybe getting back to handwritten notes. And then, you know, thank you videos. So there's just a lot of new ways that people are connecting. And that's kind of the fun part of this, is things are changing. We have to adapt to it. We have to be willing to change. You know, at the end of the day, we hope everyone's staying healthy and safe, and that their family and loved ones are doing well. We know this is taking a mental toll, a financial toll on many people, and just know we're here to help if we can in any way. So what I'm going to do now is we're going to go into questions, and we'll see if we have any questions. So thank you again, just for, you know, for listening. I hope this was valuable. Let me go get a quick check here and see how we're doing. So as I open up Q&A, somebody did ask a question, did John get a haircut? But I think that was just one of my staff. So they're obviously teasing. Yes, I gave myself a haircut and I had to get a little bit of help. So 2 participants raised their hands. I don't know what I can do with that. Let's see here. So I don't have any questions right now. I'll stick around if anybody wants to volunteer up anything. We're coming up on right about 30 minutes, which is what I try to keep these to. But if you have a question, I'm happy to entertain them. So, and while I'm kind of preparing for this, just as a reminder, Jared Ferguson, Vice President of Vance Wealth, is going to go through our tool that's available for clients called Everplans. It's going to basically be an explanation of why we think this is a great tool to utilize for you, for your family, potentially for your parents, potentially for your kids. It's a really good way to stay organized. And so if you think that would benefit you, then please attend, and it'll be at the same time, same place, 4:30 next Tuesday. All right. It looks like we got some questions here. So let me go through this. So do you see another, so here, I'm just going to go through the questions. Do you see another large stock market drop when the 4-month Fed unemployment injection ends? So that's a great question. That's always the hardest question for me to answer, right? Dealing with short-term market volatility, right? Just because there's so much uncertainty there. That's one of the primary reasons why we maintain diversification, is so that we can deal with volatility as it comes, because we know it will. I don't think that's going to be the conduit, because I think, frankly, if we're not back to work by the end of July, they'll extend it, because when you think about the unemployment benefits, if people aren't working again, that's the fastest way to put money in people's hands. And you can already tell with the magnitude of money that's been coming in through the small business programs, why would they dismiss the American workers? There's no way, especially going into the election, they're going to extend this. And so hopefully that won't be an issue, meaning we'll start to lift the stay-at-home orders, and we'll go back in. So I think it potentially would be a bad thing if it doesn't get extended and the economy was still shut down. I just don't see that as a high probability event, especially in election year. I mean, the politicians are going to do what they can to keep this moving forward. So good question. Thank you. Let's see. Hold on here. I'm going to say done. Looking forward to, okay, so that's just a comment. Thanks, Brian. Looking forward to hear about Everplans. It's a great plan. So sorry, I'm fumbling. Did you get the puppy? So I had a client say, did you get the puppy? No. And the good news is my family doesn't watch this, so they can't even know. They don't even know that I'm talking about this. And so we did not get another puppy, but we're trying to convince our dog to get into the pool because it's been quite hot up here. And so she does not like the water, but we've been enjoying some lunchtime swimming that I've been going home and getting out with the family. So did not get a puppy. I'm hoping we're not going to get a puppy. We have one. We're quite happy with that. I still might lose that battle, but thanks for the question, Liz. Question, what are your thoughts on rebalancing at this point? So rebalancing, remember, is just getting the portfolios back into alignment. So one of the things that we have been doing pretty actively, if you think about managing a portfolio, rebalancing is just putting things back into alignment. So when you have volatility, they get out of whack, we got to put it back into alignment. We're actually going through and doing some reallocation. So reallocation is similar to rebalancing, except reallocation means we're actually making changes with some of the investments that we use. So given the fact that I've gone through the economy, the recovery that we're expecting, the fact that certain industries are going to thrive, some are going to struggle, we're actually making some changes with the portfolio. So it's a little bit more reallocation where we're making decisions of saying, you know what, we don't think this sector, this part of the markets are going to perform quite as well. And so given the fact that, yes, we're going to have a new reality going forward because people are going to change their behaviors, not everyone and not completely, but there's going to be enough change that's going to benefit some industries and adversely impact others. We are making some reallocation changes. That process has started. Our investment team has been meeting weekly, and in some weeks it was daily. Changes have already begun pretty much across the board. I think we've done about 65% of our accounts. We still have another probably 4 or 5 days left. So if you have some questions about your individuals, please reach out to us because that's really an individual question because we're trying to take tax considerations into effect and trying to make good decisions. So rebalancing has been occurring, but it looks a little bit more like reallocation. So if you need some more, call your advisor, call the team. All right. A question. It says, how is Everplans different from uploading stuff to the vaults? Well, I'm not an expert on Everplans. I have not created one for myself, I have to admit. But where it's a little bit different, and it allows you to, for example, upload a lot of your documents. So that is part of it. So the vault is basically our secure document storage. So it has that component. But what you can do is actually grant access. And so you can say, okay, my daughter has access to my trust and to my power of attorney because they might need to access it for some reason if I'm traveling or if they need to just get access. You can actually grant access basically during their lifetime. You also then can set up when I die, who has access. And so it automatically basically gives the person access to all of this information that you've organized. You can also upload family photos. You can upload family stories. You can build a video library around like what I want to tell my grandkids or my great grandkids. So it really is a tool to build the story of your life, but then also grant access. Like you can put all your passwords on a bunch of your websites that you might use that once you pass, then it'll be available for your children or whoever the trustee is, whoever you grant access to. And so what's cool about that is you can grant access in your life for things that you want them to see, and you can lock down most of what you don't want them to see until you pass. So it's a different tool. It's a much more engaging. It's not just a data storage place. It's a place to really keep a little bit more history of your family. All right, so John, I've read that the economy is expecting to shrink more than 30% in Q2. How does the stock market not come down, barring immunity support from the Fed? So I don't know what those numbers are going to be. 30%. That's probably pretty close. I could see that happening. I mean, I think that my sense is I think we're going to see closer to the 20% number because I think there's some growing industries that are thriving in this dynamic. And then also you have a bunch of consumer staples. I mean, people have been buying up water, toilet paper. I mean, you're going to see growth in these areas, right? So I think 30 is a little bit high, but nonetheless, I don't have a crystal ball, so I don't know. But in terms of how's the stock market not down? Well, the main reason is I think that as investors, we're forward looking, and most people, not all, feel that this move is a temporary change for us as citizens, as human beings, that this is not a permanent lifestyle change, that we're going to be locked down forever. So I think the reason why is if you think of a value of a company, why do you invest in companies? Because over time, these companies make more and more profits. So if you take a year and wipe out their whole year of profits, what about their next 15 years of profits? They're still there. They're still valuable. And so this is a window in time where there's a lot of pain. The markets did correct. We're still down quite a bit, especially in some sectors, over 20%. So the pain is there. And the reason why that it bounced back as quickly as it did is because of the stimulus from the Fed and because of the stimulus from the federal government. Without those, we would probably have been heading into a depression because the job losses would have been so severe and people would not have been able to pay their bills. And so the stock market is now accurately reflecting that the Federal Reserve is going to come in and boost the economy, prop up the economy, bail out some companies, and that's what's keeping things in line. And so hopefully that makes sense. That's a great question, so thank you. Oh, unlimited, not immune. Yeah, unlimited. So I said immunity to sorry, on the Fed question. I think I dismissed it, so I can't pull it back up, but I think I answered that okay. What rate difference should one consider to refinance a home? Well, I'm not a mortgage professional, so I don't think I can technically give lending advice. But generally, if it's not more than like 0.5%, we have found that it doesn't make a ton of sense. But that also depends on need for appraisal and closing costs. And so just reach out to a mortgage professional. There's plenty of good ones in town. Just reach out to one and ask them. And then if rates aren't where they are, just tell them like, hey, if rates do dip down, just call me up and I'll refinance at a later time. So that's a great question. But I think that it's typically about 0.5%. But again, it depends on closing costs. It also depends on the duration of the loan and things like that. So hopefully that's helpful. All right. So with the economic shake, so it looks like I have maybe two more questions here. With the economic shakeout and many small companies that will fail when the economy was strong, there were about 6 million job openings. Has Raymond James taken this into consideration as these people find new jobs and unemployment won't be as bad as it sounds today? I don't know. That's a really tough question. We have at our localized level, when we look at our clientele, we have a lot of business owners, and a few of them are struggling just because their businesses are shut down, but the majority are not. They're actually doing just fine. And so I can't wrap my arms around what this small business failure rate is going to look like. Because in retail, it's going to be pretty massive. The mall space is going to be pretty massive. There's going to be some changes in office space and how people change. And so that's a really good question. It's a complicated one. I don't think I can even do it. I would probably have to spend way too much time on dissecting and going down into those, really drilling down into the notes on what that would look like. But we have an aging population. We have a lot of baby boomers that were on the verge of retiring, that this might send a fair amount of them into retirement. We were at a point of almost full employment. So we had anybody who really wanted a job was working. So I'm pretty confident that once we get back, we'll get these jobs back in line. We'll also have unemployment come down pretty quickly. But we're also going to have to retool as a society. We're probably going to need more medical professionals. We're going to probably need more testing centers. And there's going to be a lot of things that come out of this. And we'll realize we are short-staffed from a people perspective and a resource perspective. So it's definitely going to take a change from us. And so we know as a workforce, we can't retool it that quickly. But home building is going to continue back up. So there's the things that we're accustomed to, especially because of the amount of money in the system. It's hard to convince me that we're going to stay in this in a high unemployment scenario very long. I do think most companies are furloughing. It's temporary. They're going to bring people back. But you know what? There's also a lot of companies who are using this to purge some of their less productive workers. And those people aren't going to be hired back. And so there's going to be a group of people that are going to be looking for work and are going to potentially need retraining. So the hard thing that I continue to mention is the pain or the benefits of what's happening are impacting individuals and companies at different rates. There's no like brush that I can just paint and says this is how it's impacting everyone, every industry, every company, and to the person, it's impacting them differently. And so I think that's what we have to be careful of, is just trying to make generalizations about the overall economy, because it's complicated, and we still don't have full clarity on how we're going to get back to business as usual. Thanks for that question. Hopefully I answered it okay. Hi, John. I know we have discussed a bit before, but I'm curious if you're seeing anything now in terms of inflation troubles from the rampant borrowing currently going on. I am concerned that with other countries not buying our new notes being issued and the central bank being the only buyer, that there must be negative repercussions not being talked about. So this really is the question that I've been hearing my whole career is, we're printing money, our deficits are growing, and when's inflation coming? And I don't have an answer for that. I mean, we know that we know the theory is if you print money, if you create money out of thin air, that's inflationary, right? Because you have more dollars in the system, that creates inflation. But there's a few things that are happening as a nation. We have technology that is bringing the costs of everything down, which is deflationary. We're living through an environment where interest rates are so low, that's deflationary as well. Now, you could say it's inflationary because people will borrow too much, but it's deflationary because that's less money I have to spend to borrow, to buy my house. It brings the cost down to me, my monthly payments. We have record low oil prices. That's going to bring inflation down because energy costs are going to come down. So the printing of money is definitely going to have an impact. But I think what's happening is we have this balance of powers that we are printing money, getting more money in circulation, which should be inflationary, which means it should raise prices. But we have all these factors that are also going to temper that and bring that down. So what I would tell you is with my crystal ball that I don't have, but I will give you a solid answer for this, is I think the next 10 years, it's not going to matter. I think, frankly, we probably need a little bit more inflation, because a little bit more inflation in the system makes debt repayment. And the thing that's going to happen coming out of this, the one bad thing that's going to come out of this is US government is going to have more debt. Small businesses are going to have more debt. Large businesses are going to have more debt. Consumers may or may not have more debt, but businesses and the government are going to have more debt. And when you have a debt, what's the best thing you can do? Create inflation. Because when you have inflation, that means you have debt that's at a fixed rate, and inflation means your wages go up. So that means you get to pay off your debt that's fixed at a lower rate with more income. And so I think having a little bit more inflation is what the Fed's been trying to do, but they haven't been able to, because there's so much disruption from an inflationary perspective because of technology. And technology continues to disrupt and bring cost of doing business down. And that's not changing anytime soon. All right, so let's see here. Man, I got more questions on here, so I'll keep going. What are your thoughts on the PPP? Will the second round be more helpful than the first round? The PPP obviously is the Paycheck Protection Act, Paycheck Protection Program, excuse me. And more helpful, that's tougher to answer. I don't even know if we know the impact of what it's done for businesses, other than probably just give them a sigh of relief knowing they got extra money in the bank to keep the business operating. So the first PPP, a really small number of businesses got it. I think it was just a few million. And this next batch, there's just not enough money. I think they were saying that the subscription number for what was out there was over $1 trillion. And this next batch was only like 300 to 350 billion. So we're still underfunding it. And so the shame with this is that the PPP program is designed to keep the economy afloat, to keep people working, to keep companies going. And the challenge becomes those that got it in and get the money, they feel fortunate. Those that aren't getting it kind of feel cheated, right? Because at the end of the day, it's not really any business's right to have this money. But when a big chunk of businesses get it and there's a big chunk of businesses that don't get it, that has a bit of unfairness to it. So I don't know how they're going to remedy that and make sure that it doesn't have this, whoever got it faster, whoever had the right banker got the money, because it I think it's going to leave a bad taste in people's mouths where certain businesses got it just because they were faster and others got left out. And I don't know how they're going to remedy that. There's clearly not enough money there. So hopefully they'll revise it and make it more of a loan versus a grant, especially in industries that are still thriving. That's probably what they're going to need to do, is say, you know what, you're in the medical field, you're in the technology field. Yeah, you used the money, you got access to it, but you didn't really need it. Your business was fine. And we'll give it to you. You can keep the money as a loan, but you got to repay it. And those businesses that truly are decimated, that need it to keep going, that they'll get it forgivable. And so, you know, I don't know how that's going to play out, but that's probably something politicians are going to have to go do. It's just hard to do it after the fact, right? It's hard to do it once you've said, hey, this might be forgivable, and then you're going to go back and change the rules. So it does get a little bit trickier. So that's a good question. Another question. If we have a Fed that is spending an unlimited amount of money, why aren't big brokers recommending an allocation to precious metals? B of A expects $3,000 gold. What is your take? So typically, and this is not a rule of thumb, you know, precious metals, tangible assets tend to do well in inflationary times when there's a lot of printing of money. You know, that's a good question. You know, one of the hard parts about precious metals is that it doesn't generate any income. So if you're a retiree and you need money to live off of, a precious metal doesn't generate cash flow. So that's one of the reasons why a lot of people don't use it, is because there's no cash flow. The other thing is, I think that, you know, that yes, maybe precious metals can be worth more, but you know, there's now cryptocurrencies like Bitcoin and things like that, stuff that we don't recommend. I don't even really have an opinion on it, but those might take the place of a typical precious metal investor. And so just because we're seeing the printing of money doesn't necessarily mean that's going to be a resurgence of gold. It actually has in the past, but that doesn't necessarily mean it has to, because our financial system is so different. Go back, you know, 50 years, our financial system today looks way different than it did 50 years ago. So is that still a relevant asset? I don't know the answer to that. So having some diversification in precious metals is not a terrible idea. They can be kind of speculative, but and they can have years and decades where they don't do very well. And so you know, we're big believers of diversifying. It's hard on a webinar to say yes, I like them or not, just because I have to be very careful about giving specific recommendations. But I think diversifying portfolios is really obviously a great idea. That's part of our discipline. So it should be part of it, but certainly not too big of a piece that you could get in trouble if you're wrong, or if they actually don't pan out. All right, last one. So this will be my last one, even if more are typed just because of time. Will the European stock market experience the same kind of K recovery? Are you also moving money invested overseas? And so great question. So we do think that the U.S. recovery is going to be stronger because we have the power of our federal government as well as the Federal Reserve. That's not something the rest of the world has, at least in a very unified basis. So we think the U.S. recovery is going to be sharper. We also have some of the best companies in the world that are going to benefit from growth around the world. And so some of the monies that we're reallocating are actually coming back from overseas to the U.S. While we still like overseas, we think in this next kind of phase of the market that the U.S. markets are gonna actually do better. But we're still maintaining our broad diversification, but we are bringing some monies back in. And so those are all things individually we can discuss with you on a call. We have kind of a one-pager that we've been talking to clients about the changes that we're making. So if you haven't had that conversation with us, I know many of you are on the calendar for the next 4 or 5 weeks. We'll be having the conversation, but if you want to move that up and have it sooner, please reach out to our office. And so, hey, you've been great with these questions. I know I've been talking fast, a mile a minute. I hope this was valuable. Everybody have a great night, and I won't see you next week. Jared will, hopefully, but I'll be back the week after. So stay tuned for our next webinar, and thank you, everyone. Take care.